I'd rather pay $350,000 than make the phone call and say, hey, I lost your money.
There's not a lot of buyers out there. It's a buyer's market if you are a buyer. And there's a lot of sellers. There's a lot of people in the situation that we were talking about earlier where they can't refinance.
I lost $350,000 on one of my deals. So guess who paid out $350,000 from her portfolio to make her investor whole? And if the investor is listening to this, he will know who he is, but I never told him I was making him whole.
It's really clear. Cap rates are up in the sixes in a lot of markets, or high fives, even sevens in some areas here, even in Southern California, which when we look at our charts, that's 2012 numbers. It's amazing.
I was losing money that entire time and I could not invest. I sold every door I had.
Yeah.
So I was selling and hurting, not buying. And that's part of why I'm so aggressive now in this market, because I've been waiting for 15 years.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
Hey you, this is Christina Suter with Real Estate Breakthrough, and I have Anthony Walker here with me with Buckingham Investments, and Anthony is a friend of mine. I've known Anthony for over a decade at least.
Yeah, definitely.
Maybe longer. I don't know. I think we're aging ourselves here, but that's all right. That's all right. I don't mind being aged. But here's the thing I think is important is that one of the things that I mean, I like you, Anthony, you're great, but when you started working for Buckingham, that actually increased my respect for you. And then when you took over as CEO of Buckingham, that increased my respect for you even further, because it started with my respect for Buckingham Investments. So when I was a young punk, right, and I was taking my first official real estate courses because I was going to buy a multifamily unit and I needed to be smarter than I was, or at least more knowledgeable if nothing else. I started reading The Unofficial Guide to Real Estate Investing, which of course is Marty Stone's book. He contributed to the writing of that book.
Yes.
So Buckingham Investments became, I want to someday be that. Right? Like,
Totally.
And what was important in, I think, when I did visit Marty Stone in the Buckingham Investments office and all of that, is I remember seeing the chart on the wall of real estate over multiple years, and that line that says it generally grows by 7% year upon year in Southern California. Like I remember this moment of looking at that and going, that's the field I'm going to be in. That's what I'm going to do, right? And so therefore, my esteem for you went up because of the Buckingham Investments brand that Marty Stone had started to create. But also, you guys were all investors. Like you don't just like talk, smack, right? You guys actually understand what it means to be investors, and that was why I loved the Buckingham Investments house all the way along. Was, I was learning from like my friend Leslie Smith used to like work with Marty and all. I mean, like there's this history there of people actually be authentically seeking your success alongside of you and helping you find that success, not just because they want to sell a unit, but because they're interested in how you're going to get there and how that unit's going to serve you. And I've always respected that about the brand. And I find that now you're CEO, that brand is completely intact. And you've stewarded it forward beautifully, in my opinion. So therefore, you are an honored guest on my show because I both respect what you've done. And oh, by the way, you've maintained the integrity of the Buckingham Investment brand. So there you go, Anthony. Welcome to the show.
Thank you. What an introduction. I definitely couldn't have written that myself. Nice.
No, it's my story.
Beautiful. Thank you.
Go ahead. So tell us a little bit more about, so that means you're an investor.
Yes.
Right? That you actually know what's going on because you're not just talking smack, you're actually in the field. So tell us a little bit about maybe your own investments, your own history. Sure. Right? Go ahead.
Yeah. So like you, I was actually a client of Buckingham first. So I met Marty and Chris back in subprime crisis. I think it was 2009, 2010, something like that. Mm-hmm. And I got a hold of the same book, the little basic guide that we have that we hand out, and then the unofficial guide, the longer one. And I saw the same chart and I thought, this is easy. I don't have to invent anything or learn how to code, this looks like a pretty good way to make a business, because I was looking to start a business for myself at that point. I was in business school. And so I thought, great, I'll buy a little property. We'll get started. At that point, I was in a different industry. And, but I knew very quickly that if I could make this my full-time gig, maybe there were two complementary businesses here where if I could become an agent and then a broker and help people invest, I would have a front row seat to the market. I would really understand what's going on at a granular level. I'd have access to the deals. I'd be in it every day. And so that would help me grow my portfolio as I did that. And then probably make some more money than I used to in my old corporate job too. So we did that, and that's worked out. I've been fortunate to grow the brokerage business and eventually take over almost 10 years ago now as CEO. Hard to believe. Grow the brand, like you said. We've modernized a lot of our materials, our curriculum, but it's all the same stuff. It's all about helping people contextualize real estate investing as a component for their overall, wealth building journey and for financial independence in the future. So we try not to focus quite so much just on the deal. Although of course everybody wants a good deal. Yeah, I understand. But it is more, it's more holistic about what we're trying to do with that. And then along the way, I've been fortunate to grow a pretty sizable portfolio of buildings myself here locally, mostly Long Beach, some Torrance. I have one in Inglewood as well. And I've dabbled in partnerships, syndications, a lot of individual investing as well. And then we've seen all of our clients do all of the above as well. But most of the stuff that I have is just me. So that's been an interesting thing to see as the down cycle is playing out right now, how different it is owning the majority of the portfolio myself versus having limited partners and, general partners to answer to. And we're going through that on the syndication deals for sure, but that's been eye-opening too. So it's been an interesting time.
Okay, I want to jump on that because being able to look at that side by side, I think is particularly important. So, because I have a similar history, which is, for the longest time, I basically had me.
Right.
And I bought my own, 2000, and I think it was 2001, I bought an 18 unit on Magnolia.
Nice.
And I still use Magnolia in all of my LLC names. I still use Magnolia because it was my first multifamily investment. And it went for what it was, actually, it went relatively well. And I replumbed the building. I'm so proud of myself.
Big job.
Replumbed the building. It's a big job. It's a big job. But the point is that I did all of that, me. And then there's a point in 2004 where I started using private equity, right? So it was just me and one other person, or me and a loan from a private equity person, somebody I knew who was a client or a student or somebody who came to my Phoebe meeting, right? Somebody, and they would lend me money. And then, but I still wasn't overly leveraged. So in 2009 and 10, when it all went downhill, that was my money. That was my money I was losing.
Yep.
Right? In 2000 it was 20. So I can get this. So I sold everything, and then I went back in 2015. I started reinvesting again, and then I really was I bought flips with none of my own money.
Yeah.
So I got a private equity for the down payment. I got a hard money loan for the purchase and the construction, and I was now the backstop. And so I lost $350,000 on one of my deals. So guess who paid out $350,000 from her portfolio to make her investor whole? And if the investor is listening to this, he will know who he is, but I never told him I was making him whole. I simply said, here's your money and your interest. I'm sorry there was no growth on the equity part of your investment, but here's everything to make you whole, right? And so now all of a sudden there's a different level of anxiety. That is a different game. So now you've got them next to each other. Talk to that, because I think that's super critical.
Yeah, a lot of people don't think about that when you get in. There's benefits and drawbacks to both methods, right? Partnering up, doing syndications, whatever you want to call it, real estate private equity allows you to scale. It allows you to make huge returns if you're the general partner, right? Because you can get into that promised land of the promote or the carry, as they say, right? And then you're making money for your efforts instead of just a return on your invested capital, but you're also investing some of your money with your LPs. Gets you into larger deals. You get to charge fees. You get to make a whole business out of it. Totally understand all that. And so it's enticing when you look at that on paper and you see what can be done. If everything goes well, it looks like the fast track to riches, 8-9 figure wealth. And it can be. But we're seeing now how difficult that structure can be in a downturn, right? So really through a lot of people's no fault of their own, the financing environment has completely changed in the last 4 years. Fundamentally, a lot of deals are fine. I think it depends on where you invest, and we can talk about that too. Vacancy rates are really high in other markets, but not here. The rental market's a little bit soft, but generally the fundamentals are fine. It's really financial distress that's hit these deals. And then when you have to try and right the ship and not lose everything and not lose your investor money that you've taken, your options are much more complicated. You have to do capital calls, you have to source member loans, you have to try and get, rescue equity, rescue debt from other places. And then people are always thinking about it in terms of, when do I get my money back? I gave this to you. When do I get my money back? Where's my return? And so the mindset and the attitude is completely different. You are their servant as their GP, right? You are their steward, I should say, is a better word for it. And there's a huge burden of care involved there, right? And there's a lot more stress when you are potentially losing somebody else's money. When it's your own money, it's very different. We're experiencing the same stressors on our buildings that I own myself. I'm having to do cash in refinances in order to keep them. Yay. All the issues with insurance, tenants, we can talk about all that, right? I think that's well trodden ground at this point. But when it's your own stuff, I'm not looking at like when I get my money back. I'm not doing the IRR calculation. I'm not figuring out whether I'm getting into my promote or not. If I have to do a cash in refi because I got a building that I like, and if I have the money, I'm just going to put it in. I'm going to do it, and we're going to live to fight another day. If I don't have it and the building's not going well, I'm going to sell it, and I'm going to lose some money. And that doesn't feel good either, but it actually feels better losing your own money than somebody else's. And I would say the flexibility there when it's your own property and you don't have partners with competing priorities is so much higher that it allows you to make decisions faster and with less conflict when it's just your own stuff. So I'm kind of currently I'm not looking at doing any syndicated type stuff anymore. To me, it's been good. It's been a good experience. Some of the deals have not gone well, even though, it's been a good experience. And I've really enjoyed working with the people that I've worked with there. But it's been really eye-opening just how different it is owning stuff on your own balance sheet versus being involved in syndications. It's almost a different business, even though the underlying asset is the same.
Yeah, it is almost a different business, even the underlying assets. That's really a good summation. And I think what I would highlight in your share, and it echoes my experience, is that actually taking other people's money, some people are like, well, nobody cares about your money as much as you do. And that's accurate and true. And I've had that experience as an investor when I do hard money loans to other people, right? Maybe they're not as diligent with my money as I think I might be with my own money. And yet my experience in taking other people's money is like, I'm the freaking psychopath.
Yeah.
Like it's going to hurt me. Like, it doesn't matter whether it's their money, my money, whatever, it's going to hurt me. And to fail in the face of them, to have to make that phone call is so painful.
It is.
Right? Like that one I told you about. Like, I never told my client that property ended up being a loss. I just never told them. I just wrote them the check and I made it clean inside of me by making them whole. And that was better for me. I'd rather pay $350,000 than make the phone call and say, hey, I lost your money.
That was fortunate that you were in the position to even be able to do that.
That's
a lot
true.
of people are not.
People who are not. That is true. And it actually has affected how I assess a syndication deal.
As you should.
Because I've now learned that if they have no money that backs it up, there's no partner on there that has a balance sheet that is meaningful, then they have no choice but to make that phone call.
That's right.
Right?
Yeah. Few options.
So but I just think I want to echo, like, for people who are listening to this and who've lost their money in LP deals, like, this is what it feels like to be the LP, right? To be the GP. Like, no, we're not enjoying this conversation. No, we're not thoughtless. No, we're not. Like, at least for people like you and I, it's like, it's our integrity and heart that is behind us.
Yeah. And from a return perspective for us, we make nothing as a GP if we don't get into that promote, right? So if the deal didn't make a sizable profit for the investors, you're donating all your time to manage a building that you own 10% of, is a lot, right?
That's a lot. That's a good point.
Yeah.
It's a good point. I just wanted to highlight that for a minute. So let's dig into a little bit, like, where is multifamily right now? Because I think people really need to understand that, because I'm actively purchasing and moving into creating more syndication deals where I'm a GP or the managing partner of like a investment club, right? So I'm moving into this, not stepping away from it.
Yeah. So I think multifamily
out of my insanity.
Yeah. I think you're well positioned to do that. Now would be the time. As an asset class, cyclically, it's hard to think that we're not really bottomed out right now, or, barring some other exogenous macro event, we're going to be at the bottom of this cycle here. in the next 6 to 12
In
months.
6 to 12 months. I agree.
And it might even be behind us. It just depends on what
The amount
happens
of damage is still rolling.
in the world and with the 10-year and interest rates and all this, and some of the fundamentals in some of these markets. So when you look at the long-term charts, it's really clear. The trends are obvious. We're in 4 years into a downturn. Values are down 25% ish, depending on what you're investing in and where you're investing and what your rent roll looks like. But banks are lending. Sentiment's still pretty bad with investors. Like, there's not a lot of buyers out there. It's a buyer's market if you are a buyer, and there's a lot of sellers. There's a lot of people in the situation that we were talking about earlier, where they can't refinance. They don't have the cash to do a cash in refinance, or they can't do a capital call, or for whatever reason they're going to sell strategically and walk away. And those are the times when the getting is good if you're a buyer. So whether you're putting together syndicated deals like you are, or whether you're an individual investor like me, for the most part, it is a great time to buy. And of course, it's always that opposite sentiment strategy that you want to follow. Everybody loves tech and AI, and the stock market's raging right now. And yes, if more of my balance sheet had been in the, even just the S&P, I would have made so much more money over the last 3 years rather than losing millions of dollars. But now would be the time to rotate. The FOMO.
I'm not taking the hit on this one like I did before, but my empathy, my pain is right with you when you say that. I'm like, oh man,
it's been bad. But now's the time, right? I mean, it's really clear. Cap rates are up in the 6s in a lot of markets, or high 5s, even 7s in some areas here, even in Southern California, which when we look at our charts, that's 2012 numbers. It's amazing.
Yes.
You stuff cash flows with debt in the 6s, no problem. You can find cash flowing deals. You can negotiate. You can get reductions. You can get credits. There's tons and tons of listings available, and yet there's no buyers. So, of course, right? Because people remember what's been their recent experience. So if they've been in real estate, they have been having a bad time. A lot of people that own properties like myself, I haven't been able to be a buyer the last few years. I've had to preserve my liquidity in order to put money into the buildings and keep them, whether that's, paying down principal in order to refinance, or, replacing major systems, or dealing with vacancy or anything like that. I haven't been able to be a buyer, and I would love to be a buyer right now. I think I may be able to do something by the end of this year, finally, for the first time in a while. So there's a lot of people that normally would be your competitors that are not in the market right now. So from what we're seeing in our brokerage business, a lot of new entrants are taking advantage of that. People are getting amazing deals. Of course, they don't know what an amazing deal it is because they weren't in the business before necessarily, but it is a great time to get in if you can understand that you're investing counter to the sentiment today, but that could be a very different story 6 months from now, and you might be really happy.
It's a really good point, because I remember in 2010, 11, and 12. So I started my meeting in 2011, and all my meetings were nothing but economic. The whole meeting was, people would tease me about my stack of paperwork until I figured out that I could PDF the whole thing and people could look at it later, or look at it on their phone. But I would you would walk in and I'd hand you a stack of 50 to 60 pages. Okay, we're going to go through all this conversation about the Greek crisis, the pig, the shadow market, what's the Fed doing, right? The mark to market or not. I did that for 18 months. And then finally, middle of 2012, I'm like, okay, guys, market's done. It's bottomed out. Go buy.
Yeah.
That was my last one, and I just started getting speakers because I tracked the market, but I was losing money that entire time, and I could not invest. I was selling. I sold every door I had.
Yeah.
So I was selling and hurting, not buying, and that's part of why I'm so aggressive now in this market, because I've been waiting for 15 years for the multifamily market to be in enough pain that cap rates are seemingly quote unquote sensible, but mostly that I can buy a cash flowing building day one with a high interest rate, which means in 3 to 5 years I can refinance the building, and it is an automatic value add. If the building can cash flow today, I have a gem.
Right.
Is.
It's so different from how it was really for most of the last upcycle, right? It was all about value add. And we were using bridge debt to buy stuff that was losing money on day one, and you really needed to turn it around and able to make, in order to make money. But cap rates were so low that every dollar of extra rent on your rent roll was adding a ton to your equity position, which was great. But where it is today, like you say, your insurance is so much more powerful than having to force that value add. You can just play the economics of where it is and match interest rates with cash flowing buildings, and your potential to make a ton of money with zero effort into the intermediate future is so high right now. I think they're discounting that because we always used people are used to 10 years, almost 15 years of it's got to be value add or I'm not interested. And now we're not seeing really value add deals on the market. They're rare because the people that are selling are the people that executed on their value add deal and the debt fell apart, right? But your economics are so good, you don't have to budget for a renovation. You just buy the building, you get an incredible basis. You can chill when conditions change. You probably make millions of dollars.
I think that you probably see that in LA in particular because LA, the buildings. I invest in, as you know, in Tulsa, but so for the listeners, I invest in Tulsa, Oklahoma. Tulsa, Oklahoma is not sexy. It is completely boring. It is completely Midwest. So, they don't even have a lot of like oil money anymore. You'll see these big oil mansions, and there's not really oil money supporting it anymore. So it's completely probably just the milquetoast of markets. But it's got a 7 cap, and I can get a loan at 6.5 to 6.8. Right?
As much as you possibly can, right?
You understand. Right? So it is completely boring, and it doesn't have the appreciation. So what I'm surrendering, right, being able to buy in day one, what I'm surrendering is that I can buy day one, I have a positive cash flowing building, it will work, and it will continue to grow in value over the next 20 or 30 years, because I'm going to be investing for at least another 30 to 40 years, knock on wood. Right? Knock on wood. But it's not going to do what LA does. Right? It's also not going to do the ups. It's not going to do the downs. But what I'm seeing in Tulsa, and this is what I want to get to, is I'm seeing highly damaged buildings that are 30% occupied, 70% unoccupied because they have water damage, burst pipes, or they have fire damage, or they've lost the electricity in one of the buildings altogether. And so now there's a deep reno. So you buy it for $3 to $5 million, and you have to put in $4 to $5 million to fix it, because the amount of damage of the deferred, right, that has accumulated as they tried to hold the building up during this downturn, right? Like you said, we're 4 years into it. So 3 years ago, the building started failing, and rather than failing the building, selling it, doing what they now couldn't do anything, and now they didn't fix the electrical, or they didn't fix the fire problem, or they didn't fix the roof, and now the whole building has, one of the buildings is wiped out because the roof had a big leak which went through the entire building. They collect the insurance money and they don't fix it. Eventually, after that happens, the bank forecloses on them, and now it's on the market as a foreclosure. So I'm seeing slightly different assets than what you're seeing in LA. But let's talk about the value of the LA market, because I think for somebody like me who's an older investor, and I used, my first building was a 7 cap in Sherman, in the Valley, Van Nuys area on Magnolia, and it was a 7 cap, and it was a cash flowing building, right, which doesn't exist as much in LA, but there is a deep value in LA that people miss. So let's talk a little bit about that.
Yeah, I mean, it's really different here in a lot of ways. We don't have a lot of the buildings that you're describing, I very rarely see completely or nearly destroyed properties on the market. I very rarely see foreclosures. There's a lot of demand here. But the biggest difference in LA is the supply and demand picture for rental housing here, right? We have a severe supply shortage. Say what you will about, policy here for housing production, it hasn't been effective, right? And who knows when they're going to be able to make it effective, but we don't have enough space to live. So compared to a lot of other markets that are dealing with huge pressures from new supply and issues with vacancy on even slightly older buildings, we don't have that problem here. Our vacancy rate is still around 5%. It was even lower, like in the 3s, going back a few years ago. So it has softened a little bit. But we have the new supply here is Class A, super, super nice. It doesn't compete with the properties that, me and a lot of our clients are buying. That's like the B and C type stuff. It's just not a threat to us. So you have that dynamic going on that virtually guarantees that you're going to experience some level of rent growth and appreciation into the future. I don't think rent growth is going to be as aggressive here. in the near future as it was in the last cycle, just because of
Let's put some numbers
affordability.
on aggressive, because aggressive growth in LA is very different than aggressive rent growth in Tulsa.
Yeah.
So when you say aggressive rent growth, what are the numbers you're talking about?
I mean, I think we're going to go back to 1 and 2% for the next few
But there
years.
was a point where it hit up to 16%.
Yeah, it was crazy for a while. Yeah, I mean, you'd buy stuff, and every year you'd be getting 10% plus growth on market rents. It was like that. The market needs a while to normalize, and it is. But it's going to be, I don't see that coming back anytime soon. That being said, we haven't solved our supply problem here either. And the demand is still here. Say what you will about the U-Haul charts and people moving out of town. Not enough to change that the demand is here. And there's people moving back now too.
And that's what's important to understand. So yeah, put flesh and blood on that, because California does have a bad rap. I'm going to say for good reasons. Don't hit me through the video, but for good reasons, California has some bad raps.
We deserve it.
But there is it is a state where people reoccurringly come back to.
Yeah.
Right?
Yeah,
So
we see that. Well, we see that more and more. We see that with residents coming back from moving to lower cost of living places. The return to office is a real deal. Remote work is not as common as it was. And then we see that for investors too. A lot of people took their money out of state because the yields in the last cycle were quite a bit higher in a lot of these, southern, southeast, Sunbelt states, red states, whatever you want to say, right? Mm-hmm. Even next door in Nevada and Arizona. And that was super popular, right? But what happens with that is you get the lower regulation in those states as well. So that money is being seriously challenged with a lot of this competition from new supply. And now cap rates across the board have risen so much that we're getting a lot of people coming back here and seeing our cap rates are in the sixes too. And you can buy something 7 blocks to the Pacific Ocean, and the weather's still nice, believe it or not. It was nice when you left. It's still nice. And yeah, people still really want to live here. So people are looking at that math and the supply side things that we were just talking about and thinking, wow, maybe this overregulation thing actually did us landlords some favors over the long run. Same thing with the rent control. It's not fun to manage around, but and it doesn't work, but it creates an artificial constraint on supply of rental housing. And so what does that do to market rents? It pushes it up. What does it do to supply? It pushes it down. So if you are the incumbent and you own property here, you're going to do really well over a long period of time. It's hard to manage that stuff. But if you learn it, you play within the rules, you're going to do really well over a long period of time, and you don't have to have this going on with the performance of your property. And at a time like this, typically these gateway markets, like the big institutional money understands this stuff, and they're buying stuff here aggressively. There are very few times in the cycle when you can pick assets up in these gateway, tier one, primary, whatever you want to call it, markets where cap rates look like this. Most of the time we'd expect cap rates to be 100 to 150, 200 basis points lower even than where they are now. And so you can pick up high quality assets at a really great basis, a serious discount right now. Probably no time since that you've been able to do this in the last 15 years. And there'll be a small window right now that we can do this. And typically this will last, and it'll go away and it'll be gone for another 10 to 15 years again.
It will. And it's important to highlight that, because it's like 2026, maybe 2027, the first half of 2027, end of 2027. I'm expecting that window to close in all of the U.S. I mean, obviously regions close in their own timing.
Right.
I think all of the U.S. by the end of 2027, we're going to see this window of multifamily being down and hurting and easy to pick up in comparison to what it's been for the last 15 years. It's going to be gone.
Yeah.
Right. That's why I'm like, I've been waiting, and I'm like, I'm the money on the side of the market waiting. I trimmed my stock portfolio, and I'm moving that crap over to multifamily. Right. But I think that's important for people to understand that. And I think it's important for people to understand that if they can buy a building in LA that is the positive arbitrage I'm getting out in Tulsa, right? And then maybe you have rent control and you have the rent restrictions around that, but because our appreciation is 7%, at least that whole chart, remember we started at the beginning with Marty's chart on the wall.
Still going.
Right? Still 7%, whereas Tulsa's appreciation is not 7% on multifamily. Right. It's 2 to 3. Right. So if you've got a 7% and it's growing because there is naturally, like you said, the gateway city continues to draw attention, whether people get frustrated with it or not, it is going to be a solid investment when you can put the money down,
Right.
and you can work around the rent regulations, and you're happy with the LA market unto itself. It's still a valuable appreciation play. Even if the cash flow doesn't accelerate, it is a valuable appreciation play.
Absolutely.
It's an important part of one's portfolio when you're growing a portfolio. Now,
Right.
I'm older and I want cash flow. Right? So I'm going to stand behind my little Tulsa decision over here. And I
Well,
probably
this
won't
this is a
affect
unique time period where you can actually get cash flow here too,
Right.
because the numbers are so good. And typically, it's much harder to get cash flow here, but it's absolutely there right now.
It is. The formula used to be you had to put 50% down,
Yeah.
right,
No,
to get
not at
net
all.
neutral.
Right.
And then if you did that, then you could force a value add.
Right.
Then you could,
Exactly.
you could make a 5% cap rate.
Yeah. So much different.
Then you'd be stabilized for the long run.
Right.
And then you could refinance and get below 50% if you wanted, or stay at 50% because, 50%, I personally like being under leveraged in a building personally and in my portfolio as a whole. I like
Not a bad strategy in general, but to compare the metrics to what we're seeing today with that reality, which was what we were living in for most of the last 10, 15 years, you can put 30% down now. You can cash flow 5 to 8% cash on cash, and you can chill.
Okay, guys, if you're interested in buying a multifamily, you need to call Anthony tomorrow. Like, seriously. And I actually know people, who are hurting, who are selling, that are professional investors. And so I know there is inventory out there
There is.
because I hear that there are people like us who they got caught in the cycle like I did.
Yeah.
Right? And kind of like you have in this cycle as well.
Yeah.
So if you want to buy multifamily, Anthony, I'm going to hype you for a minute. Like, Anthony is an investor. He knows what the smack is happening, rather than using the other word. And he can walk you through it, and he can tell you, no, that's going to be a problem. And I personally lived through it. And I can tell you why it's a problem, because you understand the economics behind it, and you have all that data that Buckingham Investments has literally been cultivating its own data for decades.
Since
Right,
1965. Yeah.
Since 1965, Buckingham Investments has been cultivating granular data specifically in the beach cities that you guys serve.
Yep.
It is amazing to understand how sensitive you guys are to that market and the data you have behind you that allows you to be that sensitive to that market.
Yeah.
So
It's
thank
been
you for
fun.
continuing that tradition.
Absolutely. We're going to continue.
We're going to continue that tradition. So how do people get a hold of you? So if they're listening to me and they go, man, multifamily California, I've been waiting for years to do that, and now's my chance,
Yes.
to actually buy something that's cash flow positive.
Totally.
Yay.
So you can reach out to us on our website, buckinghaminvestments.com. You can probably find me on LinkedIn, although I'm one of thousands of Anthony Walkers in the world. So, depending on what your network looks like, you might not find me there. On Instagram, I'm Anthony Walker, CRE. And then we also have a Buckingham Investments Instagram account too that's managed. So, feel free to reach out to us on any of those channels. We pick up the phone with a real person in our office, by the way. But as a result, you have to call between 9 to 5, where you just get voicemail. So
And what's the phone? Did you give the phone number for the
310-982-7055.
And repeat it. 310.
310-982-7055.
I'm a great believer of phone number. I'm like,
Yeah.
just give me the freaking phone. Like, just let me call you directly. Eyeball to eyeball, belly to belly. This is a human field, period.
That's right.
This is Christina Suter on Real Estate Breakthrough. Thank you so much. Tune in next week for our next show.
Thank you.